My name's David Foster. We've been doing this monthly strategy focused on the offense interview now for quite a few months. This is starting to become a tradition. Today, I'm really glad to have the two people who I think have been most active in the M&A world in our universe. We've got Piers Bearne, founder and CEO of Collingwood Advisory, and also John McGovern, CEO and the owner of McGovern Associates, just to talk about what's happened in M&A and what we should be looking forward to in 2021. So Piers and John, thank you so much for joining us. It's nice to see both of you. And there's been a lot of chatter on the Slack channel about what's happening. So I'm hoping we can answer a lot of questions on that format. So as Ed just led off with his introductory comment, I would say, John, could you just sort of, in context, what actually just happened as we get into, slide into December 2020? Give us a short version of what you saw in the markets.
Yeah, sure. Thank you, David, for including me, and thanks for everyone for coming, and thank you, Piers and Stephanie. So to describe what's going on in the market, and I know that Renewed has focused on membership and recurring business models, but my comments are going to be around the business models that I think a lot of members are familiar with, which are media, events, membership, et cetera. To understand what's happened in the market this year or since COVID began, you have to understand where we were or where we're coming from, especially on the event side. On a scale of 1 to 10, we're about a 10 in terms of activity. 7 or 8 private equity firms coming back into the B2B events and media space. Just within the last 18 months leading up to COVID, it was a lot for our relatively small industry. So a lot of activity. So that's where we're coming from. In the spring, I kind of looked at our pipeline and looked at the market, and it was really, it was pretty tough to figure out what was going to happen with deal flow and so forth. So I'll give you a couple anecdotal examples and a couple of specifics about deal flow. We closed a deal with a media business that was around a beauty market. In July, we closed it. Those salons had been closed since the beginning. That buyer still went through. We got a offer on a trade show business in the summer from a private equity firm where the business was 4 trade shows, no online events, 0 revenues for 2020. It was clear to all parties involved. We still got it off. It wasn't the most competitive offer. I think the buyer was trying to feel out where the seller was. So there's some pretty, good examples of, during the summer, of continued activity. For every one of those, there's definitely other buyers that cooled it with certain deals, LOIs that went into kind of a holding pattern. The fall has come back fairly strong. The differences are, so we do about 20 transactions a year. We'll do the 20 again this year. 10 of them will be in the last quarter, which isn't always the case. The difference is 70% of what we used to sell always had an event component. Many buyers were looking for 100% events to get away from media, and now it's flipped. And I'm looking at our deal list for 10 for the end of the year, and 7 of those are media businesses, essentially media businesses. Many of them still with some print in them. And also on the list, however, is for example, consumer event business, both indoor, outdoor, that will have no live events in 2020. The moral of the story is fit. In the examples that I've given, the fit that's the asset that those buyers really want. It's one of the best or the best independently owned assets that is available or could become available in the near future. Oh, David,
great. That's a great summary, John. And I want to come back to the what's happened to the buyer pool. we'll come back to that later in the discussion, you know, because my sense is that maybe that's changed a little bit. Piers, could you, you know, give your perspective on what you're seeing, that what happened and what changed as we got to this point?
Yeah, absolutely. And I think, so I'll leave the buyers out of it, although there are some very interesting stories and pools of activity that John and I no doubt have similar views on. I mean, so starting with an anecdote, as John did, you know, the most recent business we sold was a consumer exhibition business with a bit of trade being sold to an international exhibition business, which was based in Italy and was a public company. So the number of things that could go wrong with a transaction like that were quite high. But actually, there was no renegotiation through the whole COVID period. That's not particularly confidential. That was interesting to us, but it also comes to John's first point, which is about strategic fit. So there are two things that, and we run an annual kind of pulse checking exercise with trade and private equity buyers. We ran one in 2018. And at that point, I was already concerned about the length of the bull market, because at some point, it's human nature, every 7 to 10 years, things slow down. So what happens to deal flow? And the unanimous answer from people who've been in this market a long time is there's a flight to quality. Premium businesses will still sell, but 7 out of 10 businesses, in other words, businesses that are 7 out of 10 on a scale, don't. And that's a big change. But you can actually end up paying a higher premium or selling for a higher premium if you're the key asset in the market. The other kind of deal that always happens is if somebody in a corporate or a private equity firm has got a strategy slide and it says this sector and this business model, and you're in that sector and you've got that business model, you will still sell. And I think, you know, that was the case for the deal that we just closed now.
Could you talk, that raises a great point. Would you say that the definition of quality has evolved in your market, Piers? And then
yeah, so I think there are a few different measures of it, which are always reflected in valuation multiples. So there's market leadership, market share, and with, you know, as John knows as well as I do, particularly in the events market share has been the key determinant of multiple. It's almost at the moment that's on its head, of course, because the bigger your event, the longer it's going to be before you can run it again. What everything comes back to, though, is quality of earnings. That hasn't changed. I think what has changed is that there is more and more discipline and granularity about measuring quality of earnings. So, you know, the crude measure is what's your revenue retention rate from the previous year, but there are sub measures that go into that. And every CDD process that I see gets more detailed, and the agency that's running it gets more detailed on questioning that and interrogating the client base. But that's what drives this market. Just to come back to John's point around the business model. So David, the webinar you were at a couple of weeks ago that we ran on preparing for sale, we were lucky to get the global head of M&A for the Informa group on that. And Stuart was but I was very glad, but he was really quite candid. He said, look, here's what we want to buy. We want to buy digitally native marketing solutions businesses, okay, plus subscription businesses, but he didn't feel the need to name check it because that's quite an obvious play, luckily for everybody on this call. And I'd also ask him the question of what's the event mix that you would accept, however you value the suspended events profitability. And he said, you know, anything over 40% events we're not going to touch. And that's a comment that resonates quite a lot with the other trade buyers in our sort of major UK-based buyer panel that we discuss these things with. We will come back to buyers. I think there's some quite different dynamics in the private equity and private equity-backed market that are interesting, but I hope that answers your question around the sell side.
It does. Maybe just a little more, and then I'll go back to some other points John made too, but I've seen surveys from other boutique M&A organizations that aren't quite as active as Collingwood and Grimes McGovern have been, but and you could draw the conclusion from that the majority of buyers have gone, you know, in this period of sort of fear, they've gone straight to digital. So, you know, so many of the transactions that actually finished were software or, you know, or tech plays almost more than information or content plays. Are you seeing that too, Piers, and then I'll want to go back to John.
Yeah, so there are two answers to that. In terms of our client base, it's explicitly media and information businesses, including events. So we're not playing in tech at the moment for a very good reason. I'm a great fan of blue water markets. But if you look at it from the buy side, sure, there's an increasing number of trade players who are interested in those kind of disruptive plays, whether it's kind of at a corporate capability level or as a business in its own right, a new way to attack a market. And so there's a lot of talk around information 3.0 or media 4.0, and some people are putting their money where their mouth is. Of course, from the private equity side, they're already diversified. Many of the private equity players are diversified across TMT, so it's not a big leap to look at that kind of play.
Yeah,
I'd love to hear John's view on it, of course.
Yeah, John, go ahead. Any thoughts on that, or also you talked about all the deals you have coming up at the end of the year, some of which reflect these same patterns that Piers was just talking about. Do you see this carrying into the first quarter and on into 2021, the trends you've talked about?
Yeah, I mean, I have to temper the comments by saying that, the cycle in M&A is pretty long, right? So the businesses that are closing right now that I'm describing that are closing in fourth quarter, those were folks that were kind of signed up right around COVID, or many of them probably pre-COVID, right? So there haven't been a ton of post-COVID transactions, right? To give you a really great sense of like, oh, well, multiples have done this or they have done that and so forth. So what we have seen in the businesses that are selling, that we're finding buyers from now, is the diversification. As Stuart alluded to. I mean, if you asked Stuart that question a while ago, it would have been like 99%, events he would want, or some mix of with subscriptions or other recurring revenue. So diversification, which we're always talking about, continues to be the play, and we do assessments for our clients complimentary before we sign them, to give them a sense of what their blended EBITDA looks like, applying different and blended multiples, applying different multiples to the different business lines, whether it be media, events, or data, or information services. Partially on the well, not partially, I would say mostly on behalf, or as a result of my team, talented team, some of whom are listening in right now. They have found, and we have brought and started our newest practice, which is technology, information services, and digital media, being taken there by our clients, by referrals from happy clients. So we have a lot of our traditional media and event and other types of companies looking at those, and those businesses are, a SaaS business for the HR market that is about mentoring, or another a CMS company, technology that content-oriented companies like ours would be interested in. David, you're on mute.
And I noticed Robin Crumby on the chat asked the same question. But as a result of that, are you seeing the event sector consolidating a bit? John, I'll start with you. Even though these are long tail deals you're talking about, or are they trying to, or is it more a strategy to find the kind of businesses that'll protect their flanks a little bit?
Yeah, I'm really positive about the event space, and I'll tell you why. These businesses get bought because of the pro forma financial models that buyers build that show what the businesses look like when they're put together. Those businesses, those models, pre-COVID, they didn't have a lot of online event revenue in them. Yeah. Certainly, if that seller had never done an online event, there's probably zero online event revenue in that model on which the decision to buy the company was based. Yeah. So what does that tell you? Once live comes back and online comes back, online continues, of course, the overall margin for the business is going to end up being higher. You have high margin live event to begin with, higher margin online, although smaller, they don't scale quite maybe as much. So you're going to have more profitable businesses. And we've had some sellers a couple of sellers that that took a pause during COVID, event businesses, and they're in a great position because they've slimmed down their business really well. They've done a really good job, and they are poised for growth when live comes back, and when they can do more and more online as they get better and better at it. Those are really going to be some nice margin businesses.
Yeah. Wow. Do you think so? I'll go back to the pool of people who will be in the market as we go into 2021, and maybe Piers, I'll switch back to you, and also if you want to comment on what John just said, those are some great points there. So I give you the open mic, Piers, on what you think.
I mean, I agree overall with what John said. I think that I've got a slightly more nuanced view on the impact of COVID and virtual on the events business. It kind of depends what your model is. So if you've got a buyer seller, handshake-based trade show business, you really need live to come back, and virtual is kind of a holding pattern. And it's all about what the 2021 and 2022 marketing budgets look like.
Yeah.
I think if you're more of an integrated media company, I mean, one thing that my colleague Fergus is on the call today, he's a real expert on this, but the integrated marketing solutions business where the virtual event and the live event are part of a campaign play, which actually we used to call publishing when I was younger. That's certainly making a comeback. I was talking to somebody who runs a podcast for trade show exhibitors today. The idea that you could provide both the buyers and the sellers with an integrated solution like that is great, because at the moment, if you're in tech, you'll be spending money with Tech Target over here to generate leads and buyer conversations, and then spending money with tech shows over here. It makes sense to put the two things together.
Yeah.
I think there is an issue. I would say for companies that can weather the storm, and that's going to be my third point. There's an issue around the value of the business. So multiples are going to be impacted for some time, and of course around the profitability of the business based on the economy. So trade shows and publishing businesses are very, especially with an advertiser-led model, are very far from immune to economic shocks. And I left university in 1994. This will be by far the worst one that we've been through. And I think we haven't seen what that looks like yet, because we're early in the budget setting for 21.
Yeah.
And because everybody's been thinking about, in the live events world, how do we get past COVID and all the restrictions and all that sort of stuff. So there's an economic thing as well.
What's the degree of, and I know we're sort of looking at events primarily, but I think it affects to a lesser extent. Certainly events are the most volatile right now, but it does affect, the traditional publishing businesses that are held by many of the people on this call equally, maybe not to the same magnitude. But I've had individual discussions with business owners who look like they might be down 40% this year, but more profitable. In that scenario, to me, that's a fairly dramatic example, very large event centric businesses, other than just, take 2021 and restructure the business. What counsel would you have at this point for people who are in that lower top line, better bottom line? Like, how do you get value out of that?
It depends what the three-year plus plan is, right?
Yeah.
Because if you structurally change the business and you're able to get a higher margin in a more resilient way, there's an argument for going to market early in 2021.
Yep.
Because people are looking for certainty and they're looking for capability at the moment. And what I talked about before in terms of the integrated marketing solutions model, it's pretty rare outside big corporates for people to be really good at the different elements of it. So if you've nailed it, and we have some people in that category, in fact, one mandate we're about to sign, it is a really good time to go, because you're solving a bigger problem for corporates, provided, and this is my bigger point, that matches your life goals. Because if in general, there's been a huge amount of volatility, you're not a distressed seller, you don't know what the future looks like, you're pretty sure 23 looks better than 21.
Yeah.
The advice is get good at that model.
Yeah.
Because if you go to market in 21, you've got to show some kind of quality of earnings. Quality of earnings on less than a 3-year cycle is not very exciting if you're a corporate development person in a big corporate, let alone a private equity player. So you've got to have a really good reason for trying to crystallize it. But I think we've seen some businesses where there's been a genuine digital transformation as a result of the COVID disruption, which in some ways was overdue, and other businesses that are kind of, it's a business interruption and would please like this face-to-face stuff to come back. And businesses in that situation, sure, they'll get there, but there may well be a permanently, or at least a medium-term impairment of multiples for pure play events businesses.
Yes.
The final thing I'll say, because I always bang on about this, is it's about customer value. If COVID has invited you to provide better customer value through membership, increasing your recurring revenue model, or going to marketing solutions, and you haven't accepted it, you are going to be disrupted in some way. That's inevitability. That's what the internet has shown us. And the media market has been quite slow to go through the digital transformation process, apart from, of course, the massive disruption of print to digital.
Yeah.
But this whole advertiser-led model hasn't.
It's a very good point, and it's interesting, as John started out, to reflect back where we were in the media business, say in December 2019, where there were still events going on in the media business, and the title of the events were the digital transition or transformation, which is the same title of events that were occurring in 1998. So if there's anything positive out of COVID, it's that some of those trends dramatically accelerated for a lot of the kind of middle market and larger players, if not the smaller publishers and the smaller media companies, that sort of thing. John,
We haven't quite answered Robin's question, but maybe we should come back to that after John's spoken.
No, go ahead. Piers, go ahead.
So just very quickly on consolidation. So there are different, I don't know quite which element of consolidation Robin's referring to, but I think one thing we're seeing for sure is a whole bunch of divestments. So, balance sheet impaired, particularly private equity backed players, making ready to cut loose a whole set of assets. So that's a kind of consolidation. I think, you can't really say at the owner managed business part of the market that it's a consolidation, but there's a new raft of aggressive, typically privately backed businesses looking to do value type deals, or, the larger platforms looking to do earn-ins. I don't know how many of those will be successful, because if you're willing to do a deal like that, you may well not tick the boxes of the financial diligence committee. So there's certainly some activity, and we also don't know how long it takes. I think there's a ticking bomb on the balance sheets of some of the big players around how long can you go with relatively small cash injections from your backers before you have to think about something transformative and cost oriented. I think any big player would be trying to avoid that as long as possible. And of course, the vaccine announcements have changed the dynamic on that. So there's a whole bunch of big corporate budgets where no events in 2021 was the default a month ago. Is that still the case? Is that what they're saying to their investors? Probably not. But John, I'm sorry I interrupted you. Apologies.
No, not at all. That was great, Piers.
Yeah, I agree with a lot of what Piers is saying. I think I would just add to your question, David, about what can companies do going into 2021 if they're looking at valuations and looking at selling. And I think in Q1 of 2021 will be the key period of time where there'll be some traction, hopefully, for online events that have already occurred in 2021 and some results. We'll have clarity on what's going on with live events. I saw something in Exhibition News about the UK going to a 4,000 person maximum as of December 4. And then what happens when you're selling your business during that time of the year? It's like a calendar thing. So we start working with you in Q1. We're getting you ready, and you're in the market in Q2. You're looking for offers in Q3. You've got to put out. You've got some traction, so they see your current results, what's going on in the current year, and you have to put forth a projection, and you have to keep meeting that. or it's keeping pace with it, called pacing, of course. Keep it
Yeah.
pacing up to when you're closing, which would probably be more like July, September even. A buyer might even try to wait even a little longer to make sure that you're keeping up with that plan. So that's the way sellers have to set themselves up if they
Yeah.
want to think about coming on the market in 2021.
Yeah. Well, it sounds like there, Piers hinted at some activity where the value-oriented buyers are starting to materialize. And I can say as a business owner, I've seen that in terms of the sudden rash of what I call sort of family fund acquirers touching base. I'm like 3 a week at this point, I would say, in that kind of call with people who are vaguely familiar with the industry. They're less informed than, say, your buyers would be, Piers and John, but they're curious and they like the subscription model, and they sort of stumbled onto that. So I'm definitely personally experiencing exactly what you're saying, that and they're looking for an earn-in or, you know, a low value transaction that can get them involved. You know, they want direct management. You know, they want to be active managers. So it's a different private equity kind of strategy than I've seen before. But I would summarize.
David, just tell them it's 15 times revenue is a low ball.
Yeah, well, I actually have the auto answer set up on my phone call. I say, just, you know, send the check to this Venezuelan bank account and we'll be done by Tuesday. And surprisingly enough, they haven't called back. I don't know. I'm so disappointed by that. But
David,
I do.
did you say family funds? Sorry to interrupt.
Yes. Yeah, I'm seeing calls. You know, I'm the executive director of such and such fund that represents a wealthy family in Phoenix. That kind of buyer I'm getting. I don't know if other people on this call are seeing that.
Yeah.
So
and also some
we
people
are.
who've got. Sorry, go ahead.
Oh, yeah, sorry. So in our newspapers group, which I don't spend a lot of time talking about with this crowd, you know, normally, which is very active and is led by Julie Bergman, who's actually on the call with us. And she single-handedly probably has done more newspaper transactions of a certain size than anybody in the industry, you know, in the last few years. And, you know, there's something about media with family offices, right? Like the family might like to drink soda, but that doesn't necessarily mean they're gonna, you know, want to buy a soft drink company and own it.
yeah, yes.
There's something about media where they can have a voice, right? And control. And if you're talking about B2C news media, where maybe there's a political thing going on there, but they can really be sort of a communications vehicle for a community that they are familiar with or are passionate about. And then that works on the B2B side. If there's a passion or hobby of theirs that they really get jazzed about, you know, whatever it may be, golf, tennis, or anything, then you could see that as well. So we're talking to more and more of that crowd, and we don't have a lot of transactions under our belt with that crowd yet, but we're very encouraged by what we're seeing.
Yeah. Well, I'd summarize and then I'll open it up, maybe starting with Ed's question. But I'd summarize by saying I'm hearing both of you say there are some, you know, value buyers looking around, which probably isn't where most of us on this call want to go, but that is a phenomena that's occurring. But both Piers and John, I think you both sort of referred to the idea that the job of the business owners on this call is to, you know, stabilize and create a track record for their new revenue streams. So they've got, you know, as you go into 2021, you've got a strong narrative around the fact that the new model is working and it's scalable and all of those things. If you're able to come up with that sort of narrative, I assume you're going to find a buyer at a high multiple, you know.
But it depends on other factors, of course. You know, your scale is important, you know, and actually the bigger factor is, do you need to? Because it will almost certainly be a better idea in 2 years' time, unless you're a very significant scale, unless there's somebody who's got you on their slide already, or a very similar looking slide. Why not take control of the process and build the scale and the quality of earnings metrics that will enable you to determine the timing and the value of your deal? So we're, you know, I'm sure John would say the same thing. We kind of argue against ourselves a bit, there are companies for whom next year is the right time to go to market, and we're excited about those companies. What we haven't talked about is the recurring revenue models, and I think, unless you have zero exposure to events and relatively little new business, you're going to have slower sales cycles and somewhat impacted EBITDA because of the economic situation. So what's the reason for going to market in the next year or so rather than sticking to the knitting?
Yeah.
So I'm a little bit old-fashioned like that.
No, that's true. And Ed, do you want to chime in on that comment? Because you'd asked the question just about like, for those of us on the call who are relatively light on the event side, very heavy on the membership or subscription side, Ed, anything there?
Well, just, we've been sitting, it seems like for years, we've just been seeing multiples of, on the event side of the industry, growing and growing. Media, fortunately, I think many of us on the call aren't in media, and we've been seeing those multiples sort of gradually ratcheting down to somewhere between, 3x and 0, depending on the day. And this also ties in a little bit to Stuart's question, as he was talking about events too. But so those of us in the recurring revenue, the subscription, but what I would loosely describe the subscription business, but recurring revenue, and it could be, whatever. It's kind of been flat, and I'm wondering, is this pandemic changing? Is this a blip? In which case we wait out 2 years and things go back to the way they had been before, or is this changing the way people are going to be, seeing how to value these different kinds of businesses?
I'll go first. So I think the same tenets that we have been talking about for a while will continue to hold true. We have more buyers who weren't looking at media before now looking at media, right? So that's a good thing. But there's the same issues with media, which is, what are you selling? Are you selling space? So banners, towers, and buttons on a website, or space in a print? That's only going to get a certain amount of a multiple, and it's on the lower end. So data, content marketing, campaign-based and data-based and lead gen-based is what's going to get the value. Combined with more buyers looking, means more activity and hopefully more value for those sellers.
Piers, do you have anything on that with the,
I mean, while John was talking, we always look at TechTarget as a kind of an outlier of where the marketing solutions model is going. I think it hit 70 times EBITDA last month, and it's really a highly sophisticated lead gen machine. But as John was saying, it provides a solution on a very high quality of earnings, which reflects what you get in a very successful enterprise subscription business. So at the higher end, a marketing solution can operate like an information solution. I don't think we have evidence either way to suggest that multiples will go up on subscription businesses, but I think we have lots of evidence that what will affect the multiple. And we mustn't forget that a key thing that varies between subscription businesses is average order value and average client value, as well as the retained revenue. Yeah. And if you talk to some of the bigger trades buyers over here, and indeed to the private equity panel that we run, there are some people who just don't want to play below 5 figures in annual customer value, with very good reason, because it suggests that you're highly embedded in the workflow process. And in fact, Victoria Mellor, who's on the call today, showed us a really interesting slide about her previous business, Melcrum. And actually the part of the business that she and Robin scaled was the higher value part of the business. So it's not just that people value it, it's also that it's potentially more scalable than the mass business. Those things have a really big impact on perceived and actual enterprise value.
Yeah, I think that's right. I think retention is really important. I had one of the new PE owners of a company that you would know told me in a one-on-one conversation that was the main driver that they saw in the business as a positive driver was that despite maybe being down a year, it was retention of those customers, just albeit at different levels.
Yeah.
And also we are now trying to work with our sellers to get a handle on what's going on with pricing. In other words, if a business is down, is the price per X, whatever it is you're selling, is the pricing level actually being maintained and it's just less buyers? That's a different thing than getting the race to the bottom that is discounting to try to hold on to buyers.
Yeah. I see most of, when you say that, John, just because I think a lot of us are dealing with pricing decisions, I'm seeing the discounting mostly in the media space more than, you know, somebody's saying, okay, last year you gave us $50,000. This year it's 50,000, but it'll be totally flexible. You can spend it as you use it, and it may, you know,
Right.
that kind of discounting I'm hearing a lot of. Is that kind of what you mean as something that could depress value?
Yes. Yeah, exactly. I mean, once you get into packages, it's a little more difficult, but just looking at, you know, in print media business size, you know, ad sizes and the equivalent in other businesses, what's going on with the average price, not the rate card, of course, but the average price charged.
Yep, gotcha. So we'll continue with questions. Then Steel Rose is on the call, and it's great to see you. And Piers, he just asked about your definition of earn-in, as you can see, which might be a little different than the way I'm perceiving it from the calls I've been getting. So
Yeah,
just to make, we're all clear on the same term there.
Yeah. So earning, the way that I'm describing it, as being practiced by a particular private equity-backed exhibitions business, but they're not alone in it, is we'll help you with your working capital. We'll take a smaller stake early on, and we'll earn in using your cash flow later on. So it's a semi-distressed type deal. And what it means is, rather than you starting with 60% of the value of your business, you start with a lower percent, you get the chance to earn it back or more. But of course, you're giving away control for a lower amount of money. So it's not exactly distressed, but it is value buying.
Yes, in my case, which is farther down the market than what Piers is talking about, but it has similar characteristics. They're sort of saying not so much up front, but based on what happens, the value, sort of, we'll start with a 20% share, and if you don't do very well, it'll turn into an 80% share effectively, which, that's a different way of describing a distressed acquisition. So they're certainly not very appealing offers. You're giving up, you're adding to your shareholder complexity. You're getting a little bit of cash, which if you need it, that's a great thing. But if you don't need it, you're giving away a lot for not a whole lot of liquidity. And also the other problem with, I think, these offers is, again, a lot of these people aren't quite as familiar with the industry. So they're not bringing in the kind of intellectual power where they're saying, we know how to do this. Let us come in. We'll put some money in your business and we'll take it through the roof together. That's not what they're generally saying, because they just don't have that expertise. It's a slightly different answer, but at the lower end of the market, that's literally what I'm seeing.
It's a good buyer strategy. It's tough to advise the seller to accept that. If your circumstances were not great and you didn't have a lot of options, then that where that gets tricky with any kind of earn in, earn out, as I think Piers, knows and both of us experience, is with multiple owners, some of whom may stay, some of whom may not, and you have people doing the work to get the earn out, and the proceeds of that are being shared with people who aren't staying, and then the buyer feeling like that's what they're paying for is the continued engagement or employment of those people earn that out, rather than what it really was meant for, which was consideration for buying the assets, which you transfer to the buyer on day one.
Yep. Yeah, exactly. So one of the goals of this call was to talk a bit about valuation, and I hope all of you on the call sort of got some answers around that, though I would also remind you that in this great Slack community around Renewed, we're all on the channel together, so we can keep this discussion and get in touch with one another easily there. So if you have more specific questions for anyone on the call, this is perhaps the easiest associational environment, other than Piers has a great group in the UK that's also equally as easy. This is an easy place to get further answers about your specific questions, and John and Piers are both, hugely helpful in that regard. You guys always have been, and it's much appreciated. I think you've also offered some specific advice. If you're on this call and you're an owner of a business, I think both Piers and John have suggested things we should be focusing on, which includes perhaps not selling the business at this moment, but as Piers said. So I hope there's some tangible suggestions that energize all of you on this call to keep working hard on the business as we get through whatever comes up. So maybe if there are, maybe I'd go back to kind of what we started with right at the top, because that's something I think a lot of us wouldn't see. And Piers and John, maybe you are seeing some specifics here. We've got the private equity people, we've got the, strategic buyers are still there and are still active. So we've got those traditional buyer groups, but their behaviors are changing, as both of you have alluded to. Are there new people, new players in the market, or new outcomes that you would recommend, or maybe Piers, I'll start with you, or would you go back to what you said earlier, which is just put your nose to the grindstone and get your business in good shape right now?
Yeah, well, that's one of the two things I was saying. I think the other thing I was saying was, if you have the opportunity to be a disruptor right now, whether it's with immediate or short-term exit in mind or not, that's really a good lens to look at this through. Because sometimes, especially in the recurring revenue business, there's a protection thing, right? So we're doing well with our renewal business. It's getting harder and slower to do new business. Let's make sure we optimize all this. But there may be something adjacent to you with more of a media-led business where a competitor is impacted and there's a chance to innovate and take out their business model. That's for a minority of people, but it is the first thing to do in a situation like this. And, we're working with some companies that have done that very, very effectively. One US-based company shifted from a minority membership, majority event revenue business to a 4-tier membership overnight. And actually COVID helped them to do it because the market was more open to that kind of transformation and to those conversations. So I think that's quite interesting.
John,
and say earlier on you said about the kind of buyers.
Oh.
We haven't talked about direct to private equity, so primary deals. That's something which is only suitable for a minority of people probably on this call and certainly in the market. But it's also the most cycle resistant part of the market. So we have a panel of private equity players, all UK based, who, depending on where they are in terms of their fund, there's no impact on valuations, even somewhat with event impacted valuations, because if you've got 200 million to spend over 4 years, it's not just you've got to spend the 200 million, you have to pretty much spend 50 million a year. So, but bear in mind that the barriers you've got to jump over to be acceptable to private equity are higher. The EBITDA buy-in is higher, the diligence is harder, the commitment is longer, but the upsides and the journey are potentially much greater as well. So if you haven't thought about private equity, you've got real ambition for your business, it is potentially a beacon of hope and premium valuation in times like this.
That's a very good point, John.
Yeah, sure. I mean, the way that I like to talk about this subject of what's going on with buyers types in this market is to talk about money flows, and where the money comes from to fund the kind of acquisitions that this crowd, could do or is close to. So you have private equity money, which we've mentioned. They usually M&A is a big part of their growth strategy once they buy a portfolio company and they want to spend X amount in those first 4 or so years of a 6 to 8 year ownership. We see that money as still flowing. The second is strategics who buy on the strength of their balance sheet. And we see activity there, not quite what it was. And some of the big guys, we know what's going on with them, and they have become more selective and a bit quieter. The rest of the kinds of deals that we might get involved in is really basically bank lending. And with a couple of exceptions where we did see funding come through for entrepreneurs or for really small companies, that whole bank lending thing has been really tough and pretty locked up because of what went on with the SBA and PPP and all that type of stuff. So that is really the one money flow, if you will, that was a bit drier, let's say, this year because of COVID. We have seen a couple of examples. I don't know if it's just luck, but the PE firms normally for a portfolio company, they want a minimum of 10 million in EBITDA or something like that. And we've seen them willing to do like micro platforms for something that's
interesting,
really good and strategic, fits with other stuff that they own or know, even though it's much smaller than what they would typically go for, that sits by itself as a portfolio company does.
Yeah.
Well,
We've
certainly seen companies playing down to the $2 million EBITDA level. Here, some of the lower mid-market PEs who are active in the US as well. Just one thing to put in your pot, which I forgot came up this year, David, is some venture debt. So, which is, it's debt-based, but it acts a bit like mezz finance in that there's a semi-equity-like return on it. And if there are people on this call who are super ambitious and don't want to sell, but want to raise funds for a mini buy and build, could be worth looking at. I've got no direct experience of it, but I had a very interesting chat with somebody who's done it. And it is, I think they came out of Australia originally. So just a little fun thing for you.
No, I run into a couple players like that too. And for anyone on the call, if you're curious about that, maybe, reach out to Piers or John, or, I see Helen's on the call, someone else who has some experience, Helen Hort, which nice to see you too, Helen. So, there's a lot of knowledge on this call that you can dial in to vis-a-vis your own personal experience and your own personal needs at this point. So these are intended to be 45-minute quick entrepreneurial hits, which Piers and John, you delivered 100%. That was just a joy to listen to both of you. Thanks for being part of our community and helping during these weird times. So I'll just close with a quote and a reminder that we're all in this community together, so keep the dialogue going. But I saw a quote on the front page of the FT a couple of days ago where the leader of one of the world's largest private equity firms said, multiples in all of our sectors, including, the information industry, are at the highest level. It's easy, if you've got 20% growth and an increasing bottom line, and you're above 20 million EBITDA, valuations are just great. As if that was what we were all able to do. I thought it was one of the most insulting quotes I've ever seen. Like, are you watching the economy? Do you know what's happening? So other than the get a 20% bottom line, grow 45%, and yes, you too will be very rich very quickly. I wish you all good luck with your, getting as we go into 2021.